after buying the business, the most important decision you're going to make is the management team. And like everyone says that, but like it's hard to describe how important that is. The urge to just hire someone is massive. And it's such the wrong answer. You gotta hire the right person, even if it takes longer. You can't invest enough in interviewing and referencing and all of it. Just like you can't.
John, great to see you. Great to have you on the podcast.
Thanks for having me. Appreciate it.
So we haven't chatted before, but I've been following you on Twitter for a little while. You've been pretty vocal on there. You're probably the first private equity person, maybe besides us, that I've seen get pretty active on social. How did that all start, and why are you doing that?
Yeah, I mean, so Hidden Harbor is a private equity firm I founded with a couple partners about 8 years ago. You know, what we primarily do is buy $5 to $10 million founder-owned businesses. Right. Oftentimes we're the founders looking to retire or looking for the right partner. And, you know, we'll come in and oftentimes, you know, help them kind of professionalize the business, do add-on acquisitions, grow them to 20 to 30 of EBITDA and sell them. But because of the kind of businesses we're buying, you know, most sizable institutional private equity firms are primarily buying things from the typical middle market investment banks, Houlihan, Lincoln, Raymond James, whoever. We're primarily buying most of what we buy from the small business community, from local business brokers, guys who sell a lot of $1 to $2 million EBITDA businesses, occasionally do something bigger, and who know a bunch of small business owners. And so, you know, the thinking is like, hey, how do you get our name in front of those folks so that when we interact with them on a deal, they go, oh, we know those folks, and you know, think of us as a good as a good person to do business with. I mean, I think there's an awful lot of private equity firms, I think, that maybe don't do what they say they're going to do, that retrade deals, that do a bunch of those things. And we really try to be who we are and to treat people the right way. And so we have a whole series of business brokers that have sent us multiple deals. We get them paid. You know, it creates a really good flywheel of you know, you sort of do the right thing and your business grows. And so that was the thinking. And, you know, so, and, you know, you're right. I mean, I've been doing this for a long time and have a lot of, you know, a lot of at least opinions on how the business can and should work. And, you know, I think one of the things I always say is, you know, most private equity firms aren't run as a business, right? They're run as, you know, in some ways kind of a monument to the founders' egos. And so we think private equity is just a business. It should be run like any other. So, we'll see how effective me being on Twitter is, I guess.
Have you seen any meaningful impact yet? Like, are there any like specific cases you can point to already?
Yeah, I get people reach out to me all the time. Hey, I have this deal. Hey, I have this. Hey, I have that. And it's always great to interact with those folks, but not really. You know, who knows? And so you know, part of it is also just, hey, sharing some basic thoughts on maybe some folks that are younger in the industry. And I think there is an awful lot that the whole sort of searcher, small business fundless sponsor world can learn from sponsors. You know, the private equity business has changed a lot in the 20 years since I've been in it. And like we've figured stuff out and a lot of that stuff applies at a smaller scale as well. And so I think you know, there's some good learnings there.
We've been posting on social for a little while and it's been transformative for our business. You know, I mean, you'll identify with this, but our business is basically three things. It's good businesses, access to capital to close those businesses, and talent. And I found the posting on social has accelerated the flywheel on all three of those. That's
great. Yeah.
Well, we'll see. Yeah. I mean, we've even made, I think, 3 investments now that came to us because we post on social.
That's great. That's great.
That's really powerful. When I look at your LinkedIn profile, you seem like you come out of private equity central casting. You went to Bain, you did HIG, you were at Comvest, then you started your own fund. But when we were doing this intro earlier, you actually said your first business was a startup, or you joined a startup. Will you give us a little bit of insight into that, and then how you got onto the private equity path?
Yeah, it's funny. So post undergrad, I worked in investment banking. So that's also private equity central casting, right? But did it for 2 years. and then got this kind of startup opportunity. And it was somebody that I knew and starting a business. And this is what, 1994. So this is like, nobody does startups then, right? I mean, this is way before the current wave where it's a very hip thing to do. So joined this startup. It frankly didn't really work. Spent 2 years at it, learned a ton. I was kind of the CFO, which was great for a 23-year-old, I guess I was, 23, 24-year-old. So learned a ton. Ended up going back to business school, which was a really good experience. I'm a big fan of business school for all sorts of reasons. We can talk about that later. But then it's interesting, after business school, I went to Bain & Company. So I went to consulting. And at least back then, the whole consulting to private equity path was not well trod. And so I'll never forget having a coffee with this private equity private equity recruiter in New York, who told me I'd have no chance to ever get into private equity. And he probably wasn't wrong, by the way. I still know him to this day. He's a good guy. So he probably wasn't wrong. It was probably good advice, actually. But I was working at Bain. I did a ton of work with private equity firms, and was fascinated by that kind of industry. And so I interviewed with a bunch, and I'd always do sort of really well in the interview, and then they'd hire the guy from Bain Capital, right? There was always, the fact was, hey, I could be, smart and all this kind of stuff, but I didn't really know how to do private equity. And so eventually, though, I got hooked up with the HIG Capital guys. And, I don't know if you know this, but the original HIG Capital team was mostly from Bain & Company, the consulting firm. So outside of Sammy, who was from Blackstone, a bunch of the other guys were from Bain & Company, the consulting firm. And so they were one of the very, I think, kind of few private equity firms that sort of looked at me and said, wow, super smart guy, understands finance, used to be an investment banker, understands businesses, worked at Bain for 6 years. We can teach him the private equity process. I think that was accurate. Like, when I first started there, I worked for I'll never forget it. I was 6 years out of business school. I'd been, advising Fortune 500 CEOs, all this kind of stuff. And I show up at HIG, and I'm literally working for this kid 6 months out of Harvard. And, and it was humbling, but it was good, because the truth is I didn't know how to negotiate an NDA, right? Like I needed to learn this stuff. And so, you humble yourself, and I just put my head down, and 18 months later I was running my own deals, because, it turns out it wasn't that hard to learn sort of the basics of the legal side and some of the other things I didn't know. And I did know how to think about a business, and I did know the finance side. And so I kind of quickly got up to speed. I was at HIG for 6 years. When I joined, we were a $300 million fund. When I left, I think we had like 200 investment professionals, funds across Europe. I mean, probably had 10 billion in capital under management. It's just this explosive growth. Went up to a firm called Comvest Partners in West Palm Beach. Good experience there. But then 8 years ago, decided to do my own thing. And I started Hidden Harbor, and we're on our third fund, just closed our third fund. So I've had a lot of fun with it. It's been great. Yeah.
I listened to one of your interviews where you said when you left Comvest, you had an investor, European investor, that wanted to invest in your first fund, and you'd been pushing them off, and then you had a meeting, you had maybe one meeting, and they immediately said, okay, we want to invest 65 million. First, that's amazing. Like that really gets you out of the door quick.
It's insane, right?
It's insane. It's really incredible. But what was it about you or your strategy? Like, you were just, you obviously had worked at a few different firms. There's a million different firms out there. I'm sure they get pitched by a million different firms. What was it that had them come to you and say, hey, we want to be your anchor tenant?
Well, so they're a fund of funds, that really, I mean, so what you'll find is the Europeans, and in particularly the Danes, for some reason I can't quite figure out, really like operationally focused private equity. Like they're very clear that they want to invest in folks that can really transform businesses, and they think that's sort of they're big fans of that strategy versus a lot of the U.S. investors that love software and whatever, right? SaaS companies, whatever. And so I think they really like the strategy. I think when you're spinning out and starting your own firm, when you start, you're kind of two guys in a pitch book, right? And it's all sort of talk. And so the one thing my partner and I, David, had is we were from HIG. And HIG is one of the biggest and most successful firms out there. And frankly, there have been a ton of really successful HIG spinouts too. And so, I think it was one, the HIG background, that was a big tipping point. But then, we had a really clear vision of what we wanted to do differently. And that was this whole idea that um, in most private equity firms, the way it works is every partner sort of has their deals, right? And they run their deals their way. And so every partner kind of does it their own way. And like to Dave and I, that never made any sense. Like, shouldn't we have a set of standard processes that we just do it the same way every time? And by the way, think of it as like a checklist for an airline, right? Like you wouldn't get on a plane without that pilot with the checklist making sure everything's working, right? Well, shouldn't you have that for running a business too? And so when we started Hidden Harbor, that was sort of our whole point. It's actually behind me back there. So that's our value creation engine. You can go see it on our website. Like we're not confusing about it. And that was our standardized way we're going to drive these businesses. And I really do think it's been a huge part of our success. And so, look, I think they got excited about that, and I think they liked, my partner and I, and hopefully they saw that we were, kind of carrying people. The other side of me over there is our values, and in that first meeting we talked about our values. I don't know whether they thought that was weird or good, but it worked, and so we were able to land a $65 million investor in our first meeting.
Let's talk about those business operational kind of like structure that you have behind you.
Yeah.
The operating systems that I've heard of in the past called like EOS or Traction. Did you guys take inspiration from those? How did you come up with these? Did you hire a coach? Did you just do it from the ground up yourself? Like where does the inspiration come for this?
Yeah, it's like 20 years of David and I running portfolio companies in private equity, right? And like, look, nothing in our set of 12 things is like revolutionary. It's all stuff that you find in a book somewhere, but these are the 12 things that we've found are most consistently helpful. It's also the 12 things that are pretty easy to do, right? Like these are 12 things that every small business can and in our view should do. And so they very much were developed by us. Probably 8 of them are in Traction, by the way. And I read Traction years later and was like, oh, wow, this is actually pretty similar to what we do in a lot of ways. Now, we do 3 or 4 things that aren't in there. And I think our version is better, but, Traction's also pretty good. And so, and that's the way we came up with it. We very much came up with it on our own. We have modules built on each of them that we walk our portfolio companies through. And we just find it works. But I mean, whether you're reading Traction or Power Score by Jeff Smart, which I really like, The 4 Disciplines of Execution, which is one of the best business books ever written, it all comes out of there, and then just kind of our time at Bain together.
I'm looking up this book right now, 4 Disciplines on Execution.
Oh, The 4 Disciplines of Execution is awesome. You should absolutely read it.
I'm going to check it out.
Yeah.
I'm buying it right now.
Sure.
So you guys buy a company, you guys have these principles of operation, and somebody shows up on day one with kind of a booklet and says, hey, this is our version of the Bible, operating Bible. And
No. We tell them all about it during the whole process. It's on our website. I mean, we don't show up on day one and say, hey, by the way, you got to do all these things that we didn't tell you about. We're very clear about it. We're like, hey, here's how we run our businesses. And we've had a lot of success doing it. And we would suggest you talk to our other CEOs about what we do. And so we buy a lot of businesses from founders that want to retire. And so that's a lot of what we do is we're not afraid of the founder wants to retire kind of thing. And most private equity isn't interested in that, right? They want to partner with that founder for the next step. And we do that too, but we're very willing to buy businesses from, really good guys who have, over 50 years built a really great business, but they want to spend more time with their grandkids. So we'll buy the business. We're like, hey, what we're going to do is we're going to put a lot of these processes and systems in. We're going to invest in your IT infrastructure, and we're going to start doing add-on acquisitions, and we're going to grow your business from the current 7 million of EBITDA to 20 to 30. And we're going to do that over a 3 to 5 year period. Usually usually that CEO will stay on for sort of the first year as we find the right person and they train them. And then usually they'll go to the board. and then help us with add-on acquisitions, because those guys are great at talking to other business owners about why they partnered with us and then kind of what we've done in the process. And so we do have a whole portfolio operations team. I think it's 16 people now. So we have people that can help implement the system. We have people that can help with financial reporting, which these guys are not ready for. We have functional experts that can help with recruiting and legal and manufacturing and all these kinds of things. So we bring a fair amount of resources to these business, in addition to you have to do these 12 things. And so it's, yes, you have to do these 12 things. Would you like some help? And key to our operating group is they're not there to give advice. That's not it. Ideas are easy. Execution is everything. They're there to get stuff done for the company. The CEO doesn't work for our operating team. Our operating team works for the CEO, helping them get things done. And that's our whole approach.
Got it. So for example, you guys go to a facility services company during your LOI diligence stage. You're telling them about your operating system. Obviously, they've done a little bit of research on you guys. You have some wonderful videos on your site. I like that. I think we're going to do that as well.
Yep.
And then after the acquisition, a few people from your operating team parachute down and meet with the CEO, meet with the executive team of the company. They're creating kind of like a 30, 60, 90-day plan of where do we want to be. And then they are doing the work. They're kind of rolling up their sleeves, getting the company.
We'll have probably two of our guys there 3 to 4 days a week for the first 6 months. And one tends to be implementing all of the value creation engine, which is what we call our 12 standard operating procedures. The other is usually getting their finance and accounting in line and doing the reporting and getting weekly KPIs and all that kind of stuff set up. So usually it's an execution person and a finance person that's there kind of, 3 to 4 days a week for the first, call it 3 to 9 months. And then in the background, we have help in recruiting and IT and all that kind of thing that you can call on those folks as well, right? Most of the businesses we buy are run on QuickBooks. We're going to put them on, Sage Intacct or whatever. Very few of them have a CRM system. We're tending to implement those. Sometimes an operating system, so a Service Titan, Service Trade, something like that. And then often an HRIS system as well. And so, I find founders are really good at running their businesses, but they tend to, I call it managing by walking around, right? And they can do that because, they started with one truck. And so they know every employee and every customer, and like they can just walk around and smell money being made and lost. And that works. It works really well. And so I don't want to be critical of that. It isn't scalable at some level. And so we're going to go put those systems and processes in that are then scalable, that then as we go buy 5 other things, this all scales.
I'm writing that down and I'm running with it. Managing by walking around. I've observed that in owners. I've never really been able to package it like that. That's wonderful. They just have like a feel.
It's not a criticism at all because it works.
Oh, of course.
It's great, but very and we occasionally do buy businesses where they really have invested in the software and all that kind of stuff. But I'd say 80 to 90% of the time they haven't. They've built a really great business that they're struggling to scale to that next level, and that's where we're here to help. And so, and that's what gets business owners excited. And by the way, I can give you references from 10 times we've done this, and they'll tell you we know how to do it, and it's effective. And so the key is, though, not losing the secret sauce. So somehow they grew their business to $5 million in EBITDA. That's an insanely hard thing to do. And so there was a secret sauce that helped them get there. The key is, how do I professionalize but not lose the secret sauce?
Yeah. Yeah, that animal instinct almost is incredible that an owner develops over the years, right? I've been in that seat. I've founded companies before, and it's a Wednesday at 11 a.m. and you can kind of just feel, hey, something's a little slow on the sales side, or what's going on. Like I've an inkling that something's not going well on customer service. Of course, like us stepping in as buyers, we're never going to develop that, right? That took 10 years of feeling the flow, right? Like hearing everything happen at the same time. So we need
metrics, but you can't do that also in multiple locations, right? So you can do that in a one location business, and most of the stuff we buy is like kind of one location businesses. Mm-hmm. As soon as you do that add-on, even if it's an hour away, that doesn't work anymore. So now all of a sudden you need metrics and scorecards and all that kind of good stuff.
is what are some skills that you think you either naturally have or that you've developed over the years that have made you good at this role, whether it was at HIG or Comvest or now?
Hmm. Um, I don't know that it's skills. I mean, look, I think that I think one of the tricks to private equity is that there's like two really different things you have to do. There's sort of the M&A side of buying businesses, and then there's the operating side of really running businesses and adding value. And I think that like they're really different skill sets. And I think the best firms actually don't, it's not that they hire people that have both, it's that they really partner the right way. Two people that each have one of those skill sets partners in the right way. And I think we've done a pretty good job of that at Hidden Harbor. We have one of our six partners is a pure operator. He's my partner David. He doesn't work on deals at all. He just drives the portfolio. It's been that way since the start. Um, so I don't know that there's any like sort of specific skills that you have. I think you have different kind of backgrounds and processes that work well for you. And like buying businesses and running them are really different. And so I think it's really thinking about it that way that is I find most helpful.
Uh,
That answers your
yeah,
question.
and I guess let's talk about it from the frame of people who are doing this for the first time. So you have developed your operating principles over 15 years, 20 years of doing this. Let's say somebody's out there who's either an entrepreneur or they're a business owner today. They don't know anything about these operating principles. They haven't done it enough times to develop them. Where would you start if you were them?
In terms of running a business or
No,
buying a business,
in
because they're two
terms of
different things.
developing like their own operating principles, really. Like,
So I think the best book on this is we already talked about
mhm.
is Traction, right? In the entrepreneurial operating system. It's really good. And so there's just a right way to run a business, frankly. And I think Traction is really good. It's a little hokey, but that's okay. And it's actually very, very good. I mean, I'm sort of a big fan. So like if you haven't developed your own, that's where I'd go. And because I think it's actually very, very good. And I find that it's that lack of process that most of these businesses need, even arguably more than the
Mhm.
IT side.
And I think I've heard that there's a whole roster of coaches that'll help you implement Traction. So you can like read it, you can have all your executives read it, and then you can hire someone to come in and spend a week or a few months kind of helping you get it implemented.
And there's a whole software system in addition that you can implement that's actually pretty good. So that's all set up to just do it. And I really would recommend it. I mean, I think it's pretty good. Um,
That seems like a
so
wonderful business that
especially if you haven't
I'd
already
love
done
to
it,
own.
right?
Do you have any sense of like how big they are?
Which
Traction,
one?
like the software and all that?
Well, there's a software company that's
Oh,
separate that's owned by that just got a bunch of money from a private equity firm or a venture capital firm. So yeah, it's a pretty big business. So I think there's something like 10,000 companies out
yeah,
there running it. It's pretty
yeah.
big. Now all these companies are reasonably small. It's kind of a it's kind of a system for a business that's call it 10 to $100 million of revenue.
What do you think are for people who are acquiring businesses for the first time? What do you think are some of the most common mistakes you've seen people make buying businesses in kind of the 1 to 10 million EBITDA size?
I don't know because I don't buy them. You know what I mean? Like I don't get
Yeah,
to see that. I can tell you all about the mistakes we or the things we improve when we buy a business, and we buy a lot of $1 million
yeah,
EBITDA businesses, right? So I don't know. I've never done that before. My guess is they know one of the two things. They know how to buy a business or how to run a business, and so particularly if you're a single person, right? And so whichever one of those you don't know. Um, maybe you should go find a partner that can help, but that's not always possible. The biggest thing is to admit what you know and don't know. And in life I've found that to be really critical. And so look, if you're an ex-investment banker who's out there looking for a small business and you buy your first one, the biggest mistake you can make is thinking you really know how to run it. I have a very good buddy, hedge fund guy, um, you know, kind of retired from the hedge fund world. He's like, yeah, I'm going to buy a small business and just, provide strategic advice. And I'm like, okay, stop. Let me walk you through what you really need to do to own a small business. Like, and the fact that you're a really smart hedge fund guy, like, doesn't mean you have any of
Yeah,
these skill sets. And by the way, I don't know how to run a hedge fund either. So I'm not like
sure.
being, and like in half an hour, I convinced him this was a super bad idea. So, but if you're, if you're not a rich hedge fund guy and you're looking to buy your first business, look, you got to start somewhere. And so but I think starting from a place starting from a humble place, saying, look, I'm learning here. I mean, people will give you so much rope if you're willing to admit, hey, I'm learning. I want to learn from you and I'm willing to listen. Like, you'll buy yourself a million types of rope. I mean, I find in managing people, being a little bit humble and actually caring about them is like 90% of the battle. If you really care about your people, they will put up with all sorts of stuff you do wrong. And so it really is, I think, one of the secret sauce of, kind of really, really running a team is just
Yeah.
caring. And you show that in a million ways, right?
I think that's a wonderful insight. I think being humble and acknowledging from day one, if you're buying a business and telling those people like, hey, I may not know the answers. I probably don't know the answers, but I'm going to ask a lot of questions. And some of those are going to be really stupid questions. And then, through a process of elimination, hopefully we'll get to the best result, but it's not always going to be the best result. And I've found that to be really powerful. And I think the greatest mistakes that I've probably made buying businesses were mistakes of hubris, perhaps, or, being overconfident. And the companies where we've done best are one where we've really come in and said, hey, we actually don't know, like, let's start from the ground up.
Well, part of it's what do we know versus what do we not know? Like, what do we know? We're really good at putting in scalable systems, putting in process, helping you buy businesses, helping you integrate them. But like, I don't know as much about how to run landscaping business as the guy that's been running it for 20 years. And so I could learn, there's a lot to learn both ways. And as long as you go at it with that perspective, it works pretty well.
I'm curious to hear, I mean, of course you've been doing this for a little while, but if you can point at some deals, maybe in your early days that really blew up in your face, what did you do wrong? What were some of the insights that you learned?
Gosh, that's an interesting question. Because of course, like others, I've had deals that haven't worked. I think the thing that I've learned the most over
And
the
I'll tell you why I
years.
asked this
So
question.
we're a
Like,
value
I
investor.
feel like the deals that have gone poorly, or even poorly for a bit and maybe are now doing fine, are the ones that I've learned the most from. Whereas like the deals that just have gone well out the gate, I don't learn as much from. So it's kind of like lessons etched in blood, perhaps, for me. So
Yeah,
I'd
yeah,
love to
yeah,
hear
yeah.
any stories, situations, etc.
So I think there's a couple. There's like two things that if I really look at kind of what works and what doesn't in my view, and kind of what I've learned. Number one, early in my career, I bought a lot of good businesses in tough industries really cheap. And there's some pluses of doing deals like that, right? In the sense that oftentimes they're super leverageable because they have a lot of assets, which is one of the reasons why they're not the greatest industry. And like you can really pencil out a great return there, but it's tricky because they're not in great industries. And at the end of the day, even if you kill it, they're going to be hard to sell. And so I've probably gotten over my time more and more focused on buying into good industries. And that doesn't mean SaaS software, but like industries that are pretty acyclical with some recurring revenue to them, that aren't terribly capital intense, blah, blah, blah. And because the thing you can't change about the business you buy is the industry it's in. Like you can upgrade the management team, the systems, there's all sorts of good things you can do, but you're in the industry you're in. And so that's the one thing I've learned is I've probably gotten more and more focused on buying businesses that I think are in industries that are pretty good, pretty decent industries. Number one.
And what are two,
Number two, I think
before we jump to the second point, what are two examples of those types of industries?
of good industries or
Let's start
bad
with bad.
ones. Yeah, like I owned a couple air cargo companies early in my career that were really tough industries. I was in a supermarket deal once. I've made some good money in supermarkets actually, but I think it's a really tough industry that is challenging. So those are two examples of things that I just would never do again and would never get involved in those industries. The industries that are good are all over our websites. You can just
Yeah.
go look at them, and so it's a lot of these field services businesses. It's a lot of we love aftermarket auto, which is actually super acyclical if you know much about it. So there, and one of the things we've been pretty successful at is, we invest in some industrial areas that probably aren't the hottest for private equity, but that have some really good subsegments in there. The other thing I think we're pretty good at is, let's call it HVAC. Everyone knows about HVAC, right? So HVAC is installation versus service, and everyone knows that installation is great and service isn't very. Service is great, installation isn't very good. So one of the things we've been pretty successful at is buying businesses with sort of the wrong mix and fixing it. And so those are some of the things we've been pretty successful at doing. And then doing it
What
repeatedly.
are some dynamics that you learned about in the air cargo industry that make it difficult and are also learnings that you've applied to your investing thesis in general?
Super asset heavy, super cyclical, right? Brutal. Like it's asset heavy and cyclical. And even if the assets aren't on your balance sheet and you lease the planes, you're still at the end of the day in an asset heavy industry that's going to be tough, and it's just super cyclical, right? And so you know, and the cycle eventually gets you, right? And it's always going to be hard to sell because everyone else knows that,
Mm.
right? And so they're just tough businesses, and so
What drives the cyclicality of
you
air
know
cargo? I don't know much about this industry.
the thing that drives the cyclicality of all transportation and logistics is generally your capacity is very fixed and your demand is somewhat volatile. And so you have the number of planes you have, you're building some every year, some are, getting too old to use every year. But, when demand goes up by 5-10%, there's just no more capacity. And so prices go way up. So that's true of air cargo, ocean shipping, trucking, name your form of transportation. It's sort of true, right?
And then maybe similar question for supermarkets. It sounds like you made some money in some, and maybe some of them didn't work out so well. What are the core dynamics of supermarkets that make them tricky?
It's low margin. There's actually a lot of capex required because you got to continually refresh your stores, and it's always going to be hard to compete with Walmart on price. So it's a very difficult segment. We did pretty well in some. I had a big blow up in one. It's just a tough industry, and so we've just gotten more focused on buying businesses in better industries that if we get it right, we'll be able to sell for a nice multiple. And so we've been pretty successful with
Got it.
that.
No, that's
And then the other thing I'd tell you I've really learned through the years is after buying the business, the most important decision you're going to make is the management team. And like everyone says that, but like it's hard to describe how important that is. And and particularly like if you buy a business that doesn't have a CFO, the problem is you desperately need a CFO. And everyone you meet is better than what you have. And so the urge to just hire someone is massive. And it's such the wrong answer. You gotta hire the right person, even if it takes longer. You can't invest enough in interviewing and referencing and all of it. It's just like you can't. And so yeah, having a great management team is critical, and it is good. And it's the second most important thing in your deal. And everyone says it, but it's hard to describe how important
what have
it
you
is.
learned about what are some of the qualities or experiences that you're looking for in that management team, or mistakes maybe that you've made in the past that you thought this was the right way to go, and actually you've changed how you think about it now.
What you need to figure out is what you need this business to do, and then you got to go find someone that's done that before successfully, ideally multiple times. That's it. I mean, that's as complicated as it is, right? But figuring that out is really hard, and interviewing is a whole skill, and most of us in business have never really gotten significant interview training, and so we actually use a lot of assessors, professional interviewers, who literally will do assessments for us for candidates. It can be like a 4 to 5 hour process. They're really good at it.
Are there firms that do this? I've
No,
never
no.
actually heard about this. This sounds great.
Oh,
Yeah.
absolutely.
Is there
Absolutely.
a firm you like to recommend?
All the big recruiting firms have them. There's a bunch of specialty firms that do it. If I had to give you 2 pieces of advice, one, start with a scorecard. So what you want to do is you want to write out what you want that executive to do in the 5 years you're going to own the business, very explicitly. And the more outcomes based and quantitative it can be, the better. Like literally write down what you want that person to do and then interview against that. Like literally ask them, tell me about your last business. Did you grow revenue? How much? How'd you do it? Well, all those kind of questions, but like literally go through it. Number one. And then the best piece of advice I'd give you, the best interview technique, is what's called a threat of reference check. So if I'm interviewing you, I go, Sieva, who was your last boss? And you're going to say Joe. I'm going to say, spell Joe's name. It's Joe. What's their last name? Okay, spell it. Okay, great. And then I'm going to say, when I call Joe and ask him to rate you on a scale of 1 to 10, what's he going to tell me and why? And I've done this hundreds of times, and you can see their face change. You can watch their face change where they go, oh, hell, this guy's going to call Joe. What's Joe going to say? And then they just tell you. I swear, like it works so well, and you do it nicely, but like it's not a mean question, right? It's like, hey, and like you'll have people tell you, oh yeah, Joe hated me, and let me tell you why. And so it's called a threat of reference check. And the key to it is when I call Joe, not if. When I call Joe, what's Joe going to tell me and why?
I think that's a great.
It works really, really well. And then, by the way, the third thing is you got to say things like "tell me more" a lot, or could you give me some more details on that? Like people like to tell nice high level stories, and the more you dig in, the more you learn.
I'm writing some of these things down. This is great. These are great insights. Do you have one of those scorecards you'd be willing to share? I'd be super curious what it looks like.
Go read a book called Power Score by Jeff Smart.
I think I've heard of this one.
Once again, nothing we do is like we figured it out ourselves. We just read a lot and have done it a lot and have figured out the things that work best.
Is Power Score the book that talks about top grading, or is that a different book?
It's the same thing.
Cool.
Power Score has a little bit more into it, but it talks you through the sort of interviewing process, and then it's a pretty good book on kind of employee engagement too, which I think is really important.
Tell me a little bit about the structure of your firm right now. So it sounds like it's you and a business partner that founded it. And then how many other investment professionals do you guys have? And do they focus on specific industries for you guys?
Yeah, so I founded it with two partners at the time. We now have 6 total partners. So we've grown over the years, great partners, and so that's worked out really well. We have an investment team, a business development team, and a portfolio ops team, in addition to kind of an admin team that helps us run the firm. How many people do we have in our investment team? Exclude the 6 partners, probably 15 people on the investment team, 15 people on the portfolio operations group, 7 in the business development area, and then 3 in admin. And those numbers are probably not exactly right, but you can go look on our website. It's all there.
The portfolio ops team, who do they report to, and does that person report to someone on the investment team, or is there like a?
So of our 6 partners, one of our partners is my partner David. He is our operator and he runs the portfolio ops group. So that being said, they have a bit. So he kind of manages that team day to day. But each of those people is partnered with a partner who's Usually it's two partners responsible for each deal, a lead and a support. Those people then, as they work on portfolio companies, are working with those partners.
Got it. And then those other 5 investment partners, are they industry focused or are they pretty agnostic in their search?
No. So we've taken the world of industrials and business services and split it into about 25 sectors. Each of us covers, 4 or 5 sectors. And so the way it works is when a deal comes in, it doesn't matter who sources it. It goes to the BD team. They log it, and then it gets sent to whoever runs that sector.
Got it. And then those,
So we're very industry focused.
Investors, had they had experience in those specific industries usually, or they were private equity professionals and maybe they've developed an experience in those segments since they've worked with you?
It's a mix. Yeah, it's a mix. So like we don't have experience, by the way, of the 25, there's probably 5 we have very little interest in, and so we don't really spend much time in. There's 10 that we really like, and then there's another 10 that we look at stuff. And just to give you a sense of how it works. And yeah, some of them we're super deep in. So like I do transportation and logistics. I've been doing that for 25 years. I'm super deep in it. We're really deep into auto. We know auto like the back of our hands. We're really deep into facility services and residential services. But that last one we've developed over the last 5 years. So we're some of them we're really deep in and have done deals in for 25 years. Some of them we're newer to and are learning. But the key is to be very specific about what we're looking for. And then within each of those segments, have a very, very clear idea of what we want. And so that then when, we're going to source 2,500 deals a year, when a deal comes in, we're putting it against that sieve of what are we really looking for? And that lets us very quickly jump on the opportunities that we think are the most attractive.
So a deal comes into the business development team first, then it gets pinged up to one of the investment professionals who dives in. Are you guys voting on deals together? All 6 partners get to vote, or is it just the folks who are like in that specific vertical? How do investing decisions happen?
So we don't do voting. It's all 6 partners have to agree to do a deal. And so we don't have the whole idea of we're going to vote and no. We're one team. If we're going to do a deal, we all do the deal. We're all committing to the deal. If the deal works, we're going to celebrate together. If the deal doesn't work, we're going to lick our wounds together. So that's the way it works here. The whole process is way more iterative than that. So we'll get 2,500 deals in a year. We'll sign an NDA on probably only 1,000 of them. So we'll sift out 1,500 just on industry and size, right? Just, not big enough, not the right, whatever, right? So we'll get down to about 1,000. Of those 1,000, so we'll get a booking at 1,000. We'll probably do a call with the sell side investment banker on, I don't know, half of those, maybe a third. So we'll flip through the book, say, yeah, this is interesting. Let's do a call. We'll do a call. Assuming it's interesting from that, we'll do a 1-pager, and we present that 1-pager at our Monday morning meeting. And so, hey, this is interesting. I'm interested in bidding on this. We'll talk about it. People say, yeah, it looks great. Don't like it that much. Whatever. But like any partner can bid on anything if they want to, right? Like it's, and sometimes it's like it doesn't all work out, and somebody just bids on something you're talking about, but that's fine. So the first step is just bidding on something. Any partner can do it, but they'll at least usually hear the other kind of folks in the room's viewpoints. You'll then, we'll bid on about 100 things a year, by the way. Out of that 100 that we bid on, we're going to get about 50 management meetings. So we will only get management meetings about half of what we bid on. All those we will lose on price. So that's okay. We're a value player. We lose on price every day. It's fine. So we'll get roughly 50 management meetings out of that. We'll do the management meeting. And then that's where we're really coming back and saying, okay, this is what I'm seeing. This is what I like. This is what I don't like. This is the detailed diligence plan. And that's when we really start to talk about a deal where we say, yeah, we want to dig in here. We really like it. And what we try to do very early on is get very clear within the team how much we like it and what the critical questions are. And so then we're working through to that LOI stage, on a very clear path of here's the critical questions we've all agreed to. Here's what we're figuring out. We'll sign an LOI. Once we've signed an LOI, then it's usually more confirmatory diligence, but a similar thing where we have a very clear idea of what are the outstanding questions and what do we need to know. And so it's a very iterative process. We never get to the end and go, oh my gosh, we just don't want to do this deal. Like, we have talked about it, assuming it checks out. If we sign an LOI, assuming diligence checks out, we're doing the deal. Now, the question is what happens when diligence doesn't exactly check out, and that's where it gets a little tricky. But so that's how we do it, and it's all very collaborative and all kind of working together.
And do you have a target multiple that you're usually paying for businesses that you try to stay within?
On average, we pay 6.5 times EBITDA. Okay. That's our long-term average, and it's been anywhere from 4 to 8.
And it sounds like you guys are doing quite a few roll-ups. So is your lens, we're going to buy something a little bit bigger, maybe 5 million of EBITDA as a platform company, get our head around it, and then try and go attach either local or nationwide companies to it hopefully at a lower multiple?
100%. So we do a lot of that, where we start with a $5 million business, and then we'll do add-ons, and they can be as small as $500,000 of EBITDA, as big as we could buy something that's the same size as what we bought to begin with. So yeah, that's absolutely not every deal we do is a roll-up, but a lot of them are, and that's usually what we're doing.
And what is your target exit frame? When you're doing your initial underwriting, is it 5 years? Is it some other timeline usually?
So we say 3 to 5 years because that's what private equity says. The truth is it's once we've sort of done what we do. So once I've gotten a business to north of $20 million of EBITDA with a great management team, with all the right systems and a growth path to get it from 20 to 50, I've done my secret sauce. Like, that's what we do. At that point, it's time to sell it to, Audax or Leonard Green or whoever who will take it to the next level. And so, when I tell you 3 to 5 years, it's because that's what it usually takes to do that. But we've had scenarios where we did it quicker and we will just sell it quicker. And we've had scenarios where it takes us longer, but it's not really based on the time. It's more on what we wanted to accomplish and have we gotten there.
My next question is maybe philosophical. I don't have like a specific data points around this. Is there a future where all small businesses are owned by private equity and there's no more businesses to roll up out there?
I mean, maybe, but, one, you have entrepreneurs starting businesses every day, and eventually they want to sell them. And, are there industries that look, the private equity activity in HVAC is insane, right? And I think the estimate is still that something only like 15% of HVAC in the U.S. is owned by private equity. And that's probably that is probably the segment that's been most aggressively rolled up in the past 10 years. And so you're not even close. So the short answer is yes. And oh, by the way, in HVAC, it's gotten harder. Multiples are up, so it's gotten harder, but I'm super skeptical that there's an endpoint where everything's owned by private equity. We can have this whole separate discussion about private equity as an industry, and I think there's some interesting issues there. But
it feels like so I love to study the history of private equity, and of course what's going on right now. Yeah. It feels like as time has passed, it's just like anything else, right? It's like the low-hanging fruit gets picked first, and things get a little bit harder as you go along, right? Like maybe there was a day where you could buy a wonderful business with 10 million of earnings for 4 times that was growing. And now, yeah.
We used to do it. I mean, it wasn't 4, it was 5, but yeah, sure. Like we used to buy businesses for 5 times.
And now, you're buying a business that's 5 million of earnings or 4 million of earnings for 5 or 6 times. And you need to you need to roll up your sleeves. You need to come up with an operating playbook. You need to have a team that's going to get it to that 10 million number to have maybe a similar or better results. But that just feels like where the world is going. Same thing with HVAC. Like, maybe all of the big service companies got picked off for 5 to 7 times when this whole thing started. And now, similar to what you guys are doing, and we're actually doing at one of our companies in Arkansas, is we bought a business that does a lot of that does some construction, is a primarily construction business. They do a lot of service and install as well, and we have been growing that service and install to be 50% of the business, because that's how you have to kind of put in that effort and work to grow the value of the business, the enterprise value, that is.
Yeah, that's right. So what I'd tell you though is, has private equity gotten harder? Absolutely. Because I mean, the beauty of our country is we're a dynamic capitalist country where like everyone's getting better every day. And so private equity has changed a lot in 20 years. 20 years ago, you could buy businesses for 5 times. And 20 years ago, you'd buy a business and sit on the board and give advice, and that sort of worked. And today, you better be adding a lot more value than that if you really want to drive, great returns. And so, but I also think our industry has gotten a lot better at that. And so, you know, and so I, what's the future of private equity? It's sort of unclear, right? I mean, I think two things are very clearly true to me. One, private equity is the best governance structure for most businesses. Like, I don't know if you've ever been in a public company board. Hard to describe what a disaster, right? Like, just the lack of accountability for most public companies is just astounding, right? And the boards spend 75% of their time trying to figure out how not to get sued. Like, it's just like what they do, and maybe they'll fire the CEO if they failed 10 years in a row. But like, welcome to public company world, right? So that's not great. I think founders are great, but usually they grow their business until they're sort of can't really manage them anymore. And those are the really good ones. That's what they do, right? They're good. They keep growing, and then at some point, it's like, oh, this is really hard to manage. And then forget second generation, right? I mean, that's just a pretty consistent disaster. So private equity, though, is really good at what we do, I actually think. I mean, not perfect. I mean, everyone has their private equity horror stories, and they're all true. But generally speaking, we're really pretty good at what we do. We hold our management teams accountable. We set good strategic direction. We have a good plan. If we fail, we won't raise our next fund. So, we're held accountable. Like, it's a pretty good governance structure. I think very, very successful. I think have been a huge part of the dynamic, of our country over the last 20 years. And particularly if you pull in VC, which is sort of another form of private equity, right? So that's true. It's also true that private equity fee structures are huge, right? We're going to get paid 2% on committed capital. That on invested capital, that's probably 3 to 4%, and that's off the top before our promote. And so you better be really good at what you do to earn that kind of money. And so both of those things are true. Where does the balance sit over the last 20 years? Private equity's outperformed the public comps, and there's like a million ways you can look at this, and a million, but I mean, I think it's probably directionally true. What will happen over the next 10 years? Yeah. We'll see. I think the best guys will still do really, really well, but I think our industry is getting more competitive, and for the first time, really, private equity firms have started to die. Like, it used to be that like it was really hard to kill a private equity firm. Like, now you're starting to see private equity firms die, and big ones with big names, and that's probably a good thing for our industry.
Yeah. The world is getting more competitive. I remember earlier in my career, I was in tech, building tech companies, and was doing some venture capital investing.
Sure.
And I went to a famous VC, like one of the most famous VCs in Silicon Valley. And I was kind of asking him, hey, like, tell me about your early career. How did you become so successful? And he was kind of he's a pretty funny guy. And he was kind of like, you could be a blind donkey and be successful in Silicon Valley in 1995, investing in tech companies. There was like 4 people doing it. And if you were one of the 4 people taking it seriously, like all of the value came to you, and then eventually it was a kind of self-fulfilling prophecy. And now they are like truly they're truly very good, but they have such a big brand that they still attract the best entrepreneurs. One thing that I'll say is I've been on the other side of the equation with different private equity firms, and this is obvious, of course, but there is a huge delta between elite private equity firms who really take this seriously and let's say level B private equity firms, right? And you can like feel it from day one. And it's a lot of the things that you're describing, right? Is like, do you have like operating principles? Do you have values? Are they clear? Do all of your employees know it? Are they communicating it from the first meeting? Do you have like a clear, do you have all of these elements? And is every single person on your team living and breathing that at every turn? And it's incredible to be on the other end of a table of like a class A private equity firm, because you're kind of like, yeah, I get why they create value, and I get why they get paid for what they do,
Yeah, I mean, private equity is thought of as an industry, and it is, but like firms are so different. And so, and I think you're right. The best ones are really great, but there's others that aren't so great. And so that's what the power of creative destruction is about, right? And so I think our industry is getting better. We're trying to learn every day. But you're right, and they're very different, and that's true of VC firms. It's true of everything, right? So, and look, you hear private equity horror stories all the time, and people who sell their business to private equity and they ruin it. I think, look, I think if you look at the facts are private equities earn pretty good returns. They haven't earned those returns by messing up a bunch of companies. That being said, we all know there's zeros out there, so they clearly make mistakes, but as I say, there's non-private equity owned businesses that go bankrupt too. Like, businesses succeed or fail. I think the creative destruction in private equity is pretty good, and we're all getting better every day.
I think I could talk a little bit more about the opportunities and risks of private equity, I think, and kind of like how it's evolved over history with you for a while. I want to be mindful of time, so let's wrap up for today. This is wonderful, John. I really appreciate your time. This was so fun. Thanks for going deep with us.
You bet, man. Happy to do it. Look forward to talking to you again soon.
Thanks. Thank you for watching or listening today. Any resources we mentioned during the show, we'll make sure to link in the show notes or below the video. If you're listening to this on Apple or Spotify, please leave me a review. It really helps me learn, and it allows other people to discover the podcast as well. Thanks again, and make sure you hit the subscribe or follow button if you haven't already. I'll see you next time.